Hey everyone, let's talk about something that's quietly robbing your savings, without you even realizing it. Imagine this. You're saving money in a bank account, thinking it's safe, but the bank is actually paying you less than the rate at which your money is losing value. Sounds wild, right? Well, that's exactly what's happening in Bangladesh right now, and it's raising some serious questions about how banks, central banks, and even your own financial decisions are being reshaped by forces you might not see coming. Let me break this down. Banks across the country have slashed deposit rates by 50 to 100 basis points in just a few months. That might not sound like much, but when inflation is already at 9.16%, those cuts are making your savings work harder just to keep up. And here's the kicker. Depositors are now getting returns of 8.5% to 9%, which is below inflation. That means every dollar you save is effectively shrinking in value. Personally, I think this is a ticking time bomb for long-term savings habits. People are used to earning a return that beats inflation, and when that disappears, it's not just about money, it's about trust. What makes this really interesting is that banks aren't doing this out of malice. They're reacting to a perfect storm of excess liquidity and weak credit demand. But that doesn't make it any less painful for the average saver. Let's dig into why banks are doing this. They're sitting on a ton of cash. Surplus liquidity hit TK 3.27 trillion in May alone. That's not a problem for them. It's a problem for their income. When banks have too much money, they don't need to chase deposits as aggressively. They can just invest in government bonds and treasury bills. But here's the catch. Those investments are now yielding less than 9%, which is way below the 12% they were getting a few years ago. In my opinion, this is a sign that the entire banking model is under pressure. They used to rely on lending to businesses and consumers, but now their biggest income source is investments. That's a shift that's been happening for years, but the recent rate cuts are accelerating it. It's like they're trying to pivot from being lenders to being investors, but the tools they're using to do that aren't as profitable as they once were. What's even more fascinating is how this connects to the central bank's decisions. Bangladesh Bank recently cut the policy rate from 10% to 9.5%, and that's had a ripple effect. Banks followed suit, lowering both lending and deposit rates. But here's the thing. Central banks usually act to control inflation, but in this case, they're creating a scenario where savers are losing out. A former bank director even called this decision not prudent because it's leaving depositors with negative real returns. And that's not just a technicality, it's a psychological blow. People are still putting their money in banks because they're seen as safe, but if the returns are worse than inflation, what's the point? This raises a deeper question. Are we heading toward a future where saving money is no longer a smart move? That's a scary thought, especially for people who rely on interest income to live comfortably in retirement. But wait, there's another angle. Even though banks are cutting rates, deposit growth is still strong. Why? Because people prioritize safety over returns. That's a double-edged sword. On one hand, it's good for banks because they can keep their deposits stable. On the other hand, it's bad for savers because they're stuck with lower returns. And here's the twist. Some banks, especially the weaker ones, still need to offer high rates to attract deposits. That creates a strange dynamic where bigger banks can afford to cut rates, while smaller ones are forced to keep them high. It's like a game of musical chairs where the rules are constantly changing, and the losers are the people who don't realize the game has shifted. So what does this all mean for the future? If this trend continues, we might see a generation of savers who've never experienced positive returns on their deposits. That could lead to a cultural shift where people stop saving in traditional banks altogether, maybe moving to alternative investments or even cash. But that's risky, right? If the economy tanks, cash is king. However, if inflation stays high, holding cash might not be much better than a low-yield savings account. This feels like a paradox, and it's one that's going to keep economists and policymakers busy for years. What this really suggests is that the way we think about money, savings, and risk is about to change, and we might not be ready for it yet. So what do you think? Are we on the brink of a savings crisis, or is this just a temporary hiccup in the system? Let me know in the comments, and don't forget to hit that like button if you found this as eye-opening as I did.